Okay, you're welcome to this class. Let's continue from where we stopped in the last video. Remember, we are looking at IFRS 15 on revenue from contract with customer. We already identified how important revenue is because it's really the measure of growth and survival of a business. And talking of IFRS 15, the key objective of this standard is to ensure that the revenue that is recognized in the statement of profit or loss depicts the consideration expected by the entity from the transfer of promised goods or services. And we quickly went on to how you recognize and measure revenue. And IFRS 15 recognizes and measures revenue using a five-step model. Last week, we looked at the step one and the step two. The step one is to identify the contract with customers. And before a contract is within the scope of IFRS 15, it must meet these five criteria. One is that the parties must have approved the contract. Two, each is that each party's rights regarding the goods or services can be identified. Three is that the payment terms for the goods and services can be identified. Four is that the contract has a commercial substance. Five is that it's probable that the entity will collect the consideration to which it will be entitled. If any contract does not meet these five criteria, then you cannot even recognize revenue. What you can recognize is a contract liability until you have performed the obligation, or if the money you have received is non-refundable, then you would have to still recognize it as revenue even if it does not meet these five criteria. Then we talked about contract combination, that a contract can be combined when the separate contract are negotiated as a single package, or the amount paid in one contract depends on the price or performance of the other contract, or the goods or services promised in the contract can be delivered as a single package. Then combine those contracts together. Don't see those contracts as separate contracts. Then contract can be modified, and this would occur when there is a change in the scope or price of a contract that is approved by the parties of that contract. And this change in scope must be as a result of addition of promised goods or services, and the change in price must reflect the entity's standalone selling prices of the additional promised goods or services. And when we say standalone selling price, we are talking about the price at which an entity would sell additional goods or services. Then we looked at this question on modification of a contract. Then we went on to step two, which is to identify the separate performance obligation. And here we said that you recognize revenue on distinct performance obligation. And performance obligation means the promised goods or services to be transferred. And a performance obligation or goods or service is distinct if it has a distinct function and a distinct profit margin. And also, they also mean two things majorly. One is that the customer can benefit from the goods or services either on his own or together with other resources that are readily available to the customer. The key thing there is that the customer can benefit from the goods or services on its own. Two is that the the goods it's separately identifiable. And when we say separately identifiable, that also means three things. One is that it is not integrated with other goods or services. Two is that it does not modify other goods or services. And three is that it does not depend on other goods or services. Then you know that this is a separate or distinct performance obligation on which revenue should be separately recognized. Then we looked at questions, we looked at this question and we looked at one other one. So today we would start with the step three. And the step three is to determine the transaction price. And the transaction price is the amount of consideration a company expects to be entitled to from the customer in exchange for the transfer of goods or services, excluding amounts collected on behalf of third parties. Majorly, this is just the amount on the invoice. Amount on the invoice. Of course, VAT is money you are collecting on behalf of government, so that can never be recognized as revenue. That is not a transaction price. So the consideration, which mostly will be money that you're expecting from your customer, which of course you'll have invoiced or you have agreed in the contract, is the transaction price. And talking about agreeing in the contract, you might have agreed to some variable amount like discounts. You must have agreed to some variable amount like discount. That's okay. You want to give the customer some discount, or maybe you would have given the customer like a payment terms that is extremely favorable, that the customer might not pay in the next maybe over 12 months. In that case, the revenue you recognize majorly might be the present value of that, because when you are talking about collecting money in the future and you want to recognize it now, accounting measurement basis says you need to recognize it at the present value. So you need to discount it. So transaction price would have really taken care of all of that. And that is the major difference between a transaction price and a standalone selling price. Transaction price is the price you have agreed. It will have been adjusted for by discounts or time value of money, as the case may be. But standalone selling price is the price at which you would sell that promised goods or services. That is no adjustments considered. That is a standalone selling price. So they should be the same, but they are different because transaction price will have been negotiated and agreed. Standalone selling price is the normal selling price without adjustment, right? Okay, so please note that, and that is majorly around step three. Sorry. Now let's look at this question, and this says that Mayfair supplies laptop computers. We're now told that on 1st January 2017, Mayfair entered into a contract with a customer under which the customer was to purchase laptops at 500 naira per unit. The contract states that if the customer purchases more than 500 laptops in a year, the price per unit is reduced retrospectively to 450 naira per unit. Mayfair year end is 31st December. Okay, so this is saying that the Mayfair sells laptop normally for 500 naira. But if the customer is able to buy more than 500, you would give him a discount and sell all the laptop for him at 450 naira. Okay, so let's see. And I said A, as at 31st December, March 2017, the customer had bought 70 laptops from Mayfair. Mayfair therefore estimated that the customer purchases would not exceed 500 in the year to 31st December 2017, and the customer would therefore not be entitled to the volume discount. Okay, that is in March. Then, in the second quarter, that is year ended 30th June 2017, the customer expanded rapidly as a result of a substantial acquisition and purchased an additional 250 laptops from Mayfair. Mayfair then estimated that the customer purchases would exceed the threshold for the volume discount in the year to 31st December 2017. We're now required to calculate Mayfair, how much the revenue Mayfair will recognize in quarter ended 31st March 2017 and quarter ended 31st June 2017. Okay, so quarter ended 31st March 2017. The customer only bought 70 laptop, and we estimated that the customer will not exceed 500 units. So as We were told in the question, that means we will sell to the customer at 15 naira per unit. That means we will recognize revenue at 15 naira per unit. So we simply recognize revenue at 70 laptops multiplied by 15 naira per unit. Then the revenue we will recognize in quarter ended 31st June 2017. At the end of June, the customer had bought additional 250 in the second quarter. And we now estimated that the customer purchases would exceed the threshold for the volume discount. And as told in the question again, that means we will now sell all the goods to the customer, including the 70 he had bought in the first quarter, at 450 naira per unit. So in the second quarter, the additional goods he bought was 250 laptops that we will recognize at 450 naira. However, we had recognized 70 laptops at 500 naira before, but now that we know that he is going to enjoy the volume discount, we need to adjust that. We need to adjust that. So we need to now remove 70 laptops multiplied by 15 naira, which is the excess we have recognized um, in quarter one, which is quarter ended March. And this is what I'm talking about. So in quarter ended 31st March 2017, we simply recognize 70 laptops on 500 naira, which is 35,000 naira, because it did not meet, we estimated. That was what the question told us, that estimated that the customer purchases will not exceed it. But at quarter ended March, June 2017, now we now estimated that he will meet it because he bought so much. So we recognize 250 on 450 naira first. We'll now adjust it for the excess we are recognizing in quarter one since we didn't know, right? So the excess is 15 naira because we had recognized the 70 laptop at 500 naira before. Now we need to adjust it down to 450. And the only time we can adjust it is now. Now that we don't clean in accounting. So we only update, adjust through addition and subtraction. So 70 laptops on 15 naira, which is now that our price has been reduced to 450. So we'll remove 3,500. So the revenue for second quarter is going to be this 112,500 minus 3,500. So we are going to recognize 109,000. Okay, and that's majorly how transaction price is. So this is the transaction price. So transaction price majorly will be adjusted for variations and what have you. Okay, now step four. Now this step four talks about allocate the transaction price to the performance obligation. And this would usually happen where a contract contains more than one distinct performance obligation. So then the company would have to allocate the transaction price to all the separate performance obligation in proportion to the standalone selling price of the goods or services underlying each performance obligation. So as I've told you that revenue is recognized per distinct performance obligation. So if you have a single price for bundle of goods, right? So you need to unbundle it if you have identified in step two that they are separate performance obligation. Allocate the whatever price you have agreed, which is the transaction price, to each of those performance obligation in proportion of their standalone selling prices. I mean, that will make much sense, better sense when we look at an example. Now, let's look at this question. It says that a network service company gives customer a free handset when they sign a 2-year contract for the provision of network services. The handset has a standalone price of 200 naira and the contract is for 40 naira per month. Okay, so this is a bundle of goods. One is free handset, and they said it has a standalone selling price, meaning it's a distinct performance obligation. And there is a provision of network services in Nigeria, like the airtime you buy, and you are supposed to pay 40 naira per month. So the telecom guy has decided to give you the handset for free and charges only for the airtime you buy per month. Okay, now, so how do we resolve this? Step four is just saying that, yeah, even though the handset is given for free, you still need to allocate transaction price to it. Now let's see how that would work. It says that prior to IFRS 15, the company would recognize no revenue in relation to the handset, right? And a total of 480 naira per annum in relation to the contract. Okay, that's prior to IFRS 15 because since they did not charge for the handset and they had only charged for the contract at 40 naira per month, so they will have recognized the 40 naira for the next 12 months, which is 480 naira, and in year two, too, they will recognize the same amount. But with IFRS 15, revenue must be allocated to the handset because delivery of the handset constitutes a performance obligation because it has a standalone selling price. And this will be calculated as follows. So, handset, the standalone selling price of the handset is 200. The standalone selling price of the contract, which is 40 naira per month for 2 years, is 960. So total standalone selling prices is 1,160. So let's get the proportion. 200 on 1,160 is 17%. 960 on 1,160 is 83%. However, since the total money we are expecting in the contract is 960, so it is this 960 we are going to allocate to each of these separate performance obligation in the proportion of their standalone selling prices. So we are allocating this 960 in this proportion: 17% to handset, 83% to the contract for 2 years. So in year one, the handset, we are going to recognize revenue of 17% of the 960, right, which is 162. On the contract in year one, we recognize 83% of 960. So since this is year one alone, we divide it by two because this contract is 2 years. You cannot recognize the entire 2 years revenue in year one. Accrual concept will not allow that. So we divide it by two. By the time we add the two together, we're recognizing a total revenue of 561 in year one. And in year two, the contract is going to be 399, which is the same calculation here. And that's how we're going to recognize the revenue. You will see the way we have allocated the transaction price, which is the price agreed in this contract, which is 40 naira per month for 2 years. We have allocated it between the handset and that contract, even though they are giving the handset for free. But because the handset is a distinct performance obligation, you have to allocate revenue or transaction price to it, right? So we are going to recognize 162 relating to the handset. And that's the idea about allocating transaction price in proportion to standalone selling prices of each distinct performance obligation. Finally, step five. And step five says you recognize revenue when or as performance obligation is satisfied. Yes, so when you have calculated your amount in step four or in step three, depending on whether they are single or multiple performance obligation, then as soon as you have satisfied the obligation or when you have delivered or transferred the promised goods or services to the customer, then you recognize revenue. However, revenue in recognition is either you are performing the obligation at a point in time or over time. I mean, over time will represent that it takes you a long time to complete the delivery of the goods or for the good to be ready for the customer to benefit from. So, some indicators of that obligation is satisfied over time is that the customer is receiving and consuming the benefit as the performance is taking place. It's just like ICANN classes that takes 3 months, right? The school should not recognize the entire money right from day one. They should recognize revenue as performance is taking place because that is a performance satisfied over time. So you don't just recognize revenue at the beginning. You have not satisfied the obligation. So a school in month one, you will recognize revenue equivalent to month one. In month two, you will recognize a cumulative revenue equivalent to those 2 months until when it has completely satisfied the performance obligation. That is when you would have recognized the entire revenue. Another indicator is that if it has to do with creation of assets, so as you are creating the asset the customer control, right? It's I mean they are creating it, and as they are creating it, the customer is having control. That's for an asset perspective. And also is that the entity or the seller would be entitled to payment to the performance completed to date. Right? Either of those three will represent that or show that performance is satisfied over time. Okay, now another term under step 5 that you should note is contract costs. Contract costs. And contract cost simply is the cost of obtaining a contract or the cost of fulfilling a contract. There are two separate things. Cost of obtaining, cost of fulfilling. Cost of obtaining will majorly be sales commission. If you have to pay some marketers money that okay, go and get this job. When you get this job, I'll pay you 5%. That is it's a contract cost. You see, if you are sure that this money you want to pay to this guy, you would recover it. Okay, so you recognize that money as asset. So when you recover the revenue, so when you recognize revenue, then you expense that asset. That means you transfer it from assets, you take it to expense. However, if you have or if you are going to incur a cost and you are not sure that you recover that cost, or you would incur the cost anyway, whether you would earn revenue or not, you still expense or you will still incur the cost. Then that kind of cost should be expensed straight away. You don't need to go and suspend it by putting it in asset. Since regardless of whether the contract is obtained or not, you would pay the money. If you have entered into that kind of arrangement with a marketer, then expense that contract cost. That's the cost of obtaining a contract. And that is a contract cost. But a contract cost can also be cost of fulfilling a contract. Okay, so if you have gotten a contract, of course, if you have to buy materials, labor, overheads, incur all of that, to get the goods delivered to the customer. So as you are incurring those costs, you would have to capitalize those costs. So when you eventually deliver and you earn revenue, you expense it, then you would take it away from asset and expense it. So majorly, that is a contract cost. Now, another one is when performance is satisfied at a point in time. So this is the one that is common. It's just like you went to buy a ready-made goods, so you pay, they deliver you goods. That's performance satisfied at a point in time. And the indicator of that is that immediately the entity has a present right to payment. So the entity, whoever is teased as the seller, has right to receive payment immediately. The customer immediately has legal title to the asset. The entity will have transferred the physical possession of the asset, and the risk and reward of ownership has also been transferred to the customer. Now, two terms I need you to note that I've not mentioned. One is contract assets, two is receivables. Let me start from receivables, which is common. You see, when you sell goods to a customer and you have delivered or transferred the goods, but your right to consideration is unconditional, meaning that what is delaying your payment is just passage of time. Then, in that case, you would, of course, recognize revenue and the corresponding debit will be trade receivables. You recognize trade receivables where your right to consideration is unconditional, meaning you have done your part. It's just that you have given the customer, let's say, 3 month credit terms, and you are waiting for that 3 months to lapse for you to collect your money. However, there are instances where You have also delivered the goods, but your right to consideration is still conditioned on something else other than passage of time. It's not about passage of time now, it's about other things. And that's a scenario whereby you have also made some commitment that you will do one or two things, maybe for the next few years, so or few months. So that means your payment is still conditional on future performance. Maybe you're waiting for the product to work, or whether it will work or whether it will not work. So in that case, the debit to revenue is not going to be, by the time you credit revenue, you won't debit receivables. You will debit a contract asset. Okay, that's where your right to consideration is conditional on something else other than passage of time. It's not about time, it's about future performance you have promised in the contract. Okay, please and please take note of that. And again, the final one is this: if you had delivered goods, but you did not send invoice, you cannot debit receivables, you debit a contract asset. Okay, so finally, I need you to look up on the disclosure requirements that are here. They are also very important. And thank you very much.